Welcome everybody to this webinar presentation presenting you 101 Ellwood, our new acquisition in Baltimore's Canton neighborhood. I am Dr. Julius Oni, CEO and co-founder at XSITE Capital, where we collaborate with our community of investors to buy cash flowing multifamily properties. And am I excited? Super duper excited to present a property to you that is right just in my neighborhood, right in my backyard. All our acquisitions up to this point has been away from the city where we lived in. It feels really good to finally get something at home. And what a property to start with. 101 Ellwood is a 140 unit, and this is the table of contents. And look at that beautiful picture of the atrium there. Just a little bit of disclaimer right before getting right into this. I'm only licensed to replace people's hips and knees. So certainly not a financial advisor, and so please reach out to your professionals to confirm the veracity of all the information that's been shared with you. Do your due diligence, double check these things to make sure that this investment opportunity is a good fit for your portfolio. This is to educate you about the opportunity that we are presenting. It's not intended to be a general solicitation. So just a few pictures showing you just the overview of what the property looks like, this 101 Ellwood property. And just a little summary about the property itself. It was built right in 2014. It was converted from a high school to apartments, and 140 units. It's currently about 96% occupied, and we are buying this property at an amazing basis, and I would explain that to you very shortly. This property is very walkable. It's close to all the attractions in Baltimore that Baltimore has to offer. It's right centrally located between the two major Hopkins Hospital, Johns Hopkins Hospital and Johns Hopkins Bayview. It's right in front of Patterson Park, which is the Central Park of Baltimore. It's literally the largest public park in Baltimore, and in that particular park hosts a lot of events throughout the year in Baltimore. So this property is located also in the Canton neighborhood, which, as you will realize later in this presentation, is one of the highly sought after neighborhoods in Baltimore. So once again, just getting into 101 Ellwood, just a few cool pictures showing you the entrance and the lobby a little bit. And this is a picture from the building itself overlooking Patterson Park. So just a little bit of summary of this property. It's a cap. The entry cap rate that we're buying this property at is a 5 cap. The expense ratio currently is 50%. For a property of this size, and of a property that's a Class A property that's just been built just in 2014, less than 10 years old, that expense ratio is relatively high. So our goal is going to be to get that lowered as part of our business plan, and we'll discuss that very shortly. The occupancy of the property right now is at 96%. And we're planning to have a debt service coverage ratio of at least 1.6%, or 1.6 rather, meaning we're going to have more than enough to cover the mortgage and all the expenses for this property once we have it nicely stabilized. The purchase price is going to be 25.425. We plan to hold it for 3 years, and we are raising a little over $9 million for it, with just a little under half of that already been raised by our team. The internal rate of return is going to be a little under 17%. The average annual returns is going to be anything from 18.5% to 21.6%. And the equity multiple is anything between 1.5x to 1.6x, all in 3 years. So once again, this is 101 Ellwood, and let's move right on to talking a little bit about the property profile. So 25.45 mil is how much we're buying it again, or 25.425 mil rather. The average unit size is about 751 square footage, and we'll talk about that. It's 5 minutes from both Hopkins Hospital, and the average annual rent growth is anticipated. The CoStar projection is 5.87, but you will see our underwriting later to see that we are actually projecting less than that because we like to be conservative. Just a few more pictures showing this amazing and beautiful property. The current amenities on the property as listed on this slide, and I hope you can appreciate that beautiful workout space, the fitness center. They've got a nice rooftop deck with a community grill. There's a business center. There's electric car charging. I mean, this is really a building that fits the new generation. Certainly, you know, for folks that have electric cars, they will have a place to charge their vehicles in this particular building. There's indoor garage. There's controlled access to the building. Just beautiful property. The residents pay their electricity and water. We, as the owners, are going to be paying the trash. It's a combination of 1 bedrooms and 2 bedrooms for the most part. There are only 6 studios in this property, but this is perfect for the demographic that this property was designed for, which is usually the young professional. So, and just look at the prices of the units there, about $1,463 to about $2,000 is what the dollars per unit per month is. I want you to really pay attention to that, because when I start showing you the comparables, you will see that this property is located closer to the bottom, closer to the lower hand of the comps. So apartment, the home interior is listed there. This is a beautiful property with a beautiful rooftop, with a beautiful atrium area. Just more pictures, just to kind of let you really get a sense of this is one of the common spaces, just to get you to get a sense of how gorgeous this property is. It's got some lofts, and this is just an example of one of the loft apartments. Once again, just kind of showing you the proximity of this property to different parts of Baltimore, including Federal Hill, Fells Point, Inner Harbor. This is the Canton waterfront park is walking distance away. And you can see the home prices of properties around this property. I mean, it's home prices could be anything from $400,000 to over $1 million, in like just within walking distance of this particular property. And Patterson Park is the greatest attraction here. It's the largest public park in Baltimore and hosts a lot of events there. So this, I say all of those things to say that this is a very desirable location, and it's ideal for like the young professional who is moving into Baltimore for one job or the other. So just a little bit about the natural rental base. We have a lot of institutions in Baltimore, including my employer, Johns Hopkins Hospital. University of Maryland is close by. MICA, the Maryland Institute of College of Art, is close by. And the Baltimore metro area definitely is steadily growing and continues to outperform other comparable size metro areas. And as you can tell, DC is already mostly maxed out. A lot of the overflow from DC with regards to employers and even the employees is Baltimore is really starting to take great advantage of it. And as of November 2021, there were at least 1.3 million jobs in Baltimore. That's impressive. The population as of April 2020 is a little under 600,000 and growing. Just a little bit to show you about the diversity of employers in Baltimore. You have everything from Under Armour to Johns Hopkins to Mercy to all these different hospitals to financial institutions to Amazon close by. Baltimore also has gotten a lot of awards recently, most resilient city in the nation, best city for college grads, largest life sciences hub in the nation, and is starting to be known for its tech talent also. So what is our business plan for this deal? We are doing a relatively light value add. We're just going to make sure that we are maintaining the brick walls. We're repainting the hallways. We're going to modernize the lobby. We're going to also maybe add some smart thermostat, do a little bit of smart upgrade, add some USB charging ports, upgrade the lighting in the units, all the things that will add significant value that the tenant base are going to be very happy to enjoy. We plan to be done with all of our light value add and renovations within 12 months. The average cost per unit for this value add is going to be only about $1,500. Just for people who are not familiar, when we do classic value add deals, we are spending at least $7,000 to $10,000 per unit. This unit is still very new and very modern. So we're really not going to need to spend much. And we also like to keep about $400,000 in reserve, just in case we find something that we weren't expecting. So the total value add cost is going to be a little over $1 million. So business plan wise, we are going to make sure we have a rent growth projection of 3%. That's just, classic 3% rent growth projections, even though the rent growth that CoStar projected on this is over 5%, closer to 6%. But we want to be conservative. We're saying, you know what? We know we're going into a very interesting period right now in the real estate cycle, or at least with the economic cycle. And so we want to make sure that we are projecting conservatively. So now if we're able to do 5%, great, because the market allows for it, fantastic, but we're not going to bank on it. We're going to say 3% average rent growth projection just to match inflation or cost of living increases. And the market rents in this particular building is below comps in the area, and I'll show you the evidence for that very shortly. The current average effective rent in this particular building is $1,763. The entry effective rent for us going in is about $1,500, and we are projecting an average effective rent of a little over $1,800 or closer to $1,900, which is very close to what the current market average is. So this is not a classic value add where we just bump up rents. The and increase the rent significantly throughout the projected old. This is one where we want to manage the expenses, make sure we minimize the expenses, just keep the rents relatively where they are and get them just away of the market, close to where the market is, and then implement our business plan that way. And this deal still works. So we're purchasing this at about $181,607 per door at a total of $25.425. What's the business plan again? We are going to bring in a local third-party management. This particular building has never had a property manager in it for more than 6 months, because we are buying it from a group that are based out of Florida, and they have an in-house property management group that they've been using to manage this property. So this property has really not had a very good operation over the last few years that this has been held. Also, when the current owners bought it just right before COVID hit, so they also had a little bit of challenge there. But our goal is to bring in a local third-party management company that really understands the market, to stabilize the property operation, once the property operation is stabilized, we'll exit in year 3, and we expect that we will be able to deliver on our average annual return projections of between 18 and 21.6%, with a equity multiple of 1.5x to 1.6x. So we expect that we'll be able to give our limited partners, those of you that are going to bring your equity to this deal, a 6% cash and cash and preferred return. So on the cap stack, on the capital structure, you as the LP are right next to the bank. So once the bank gets paid, then you get paid as the LP, and you get paid that 6% cash and cash first. But we anticipate that at the end of the business plan, based on our projections, that you will still be able to end up with at least 18% average annual return, 6% of which you'll get as cash on cash. We split in this deal with our limited partners, 75-25, with the limited partners owning about 75% of the deal. If we outperform our projections and we get you to over 20% average annual return, then we start splitting everything beyond that 50-50. This encourages us to really work hard to over deliver for you, under promise and over deliver. Once again, the average cash and cash, meaning if you invested $100,000, you get $6,000 annually divided into quarterly payments. That is what you can expect with this deal. And equity multiple, once again, 1.6x. Oh, it goes to investor returns based on a $100,000 investment, $6,000 divided into quarterly payments in years 1, 2, and 3. Upon sale of the property, we expect that you would be able to get your share of the profit, and we expect that conservatively that you can make at least $155,000 on your $100,000. If you were to, we are projecting exit cap of 5.45 on this. Typically, you increase the cap rate by 10 basis points on these deals when you underwrite them, but we are doing it by 15 basis points. We're saying, you know what? Cap rates may continue to expand based on the increase in interest rate. So we saying the cap rates are going to expand compared to where we bought it today by at least 15 basis points per year. And in 3 years, we will be exiting this at like 5.45 cap. That's where our projections stand. But even if we did a little worse than that, and the cap rates expanded to 5.6%, then we are talking about still a 1.48, almost a 1.5x equity multiple, but the average annual return would have dropped to 16%. So let's look at some rent comparables. This is some of the comparables. These are just properties that are all within like 1 mile of 101 Ellwood. I want you to notice that most of this are almost completely occupied, almost fully occupied, 99%, 98%, 100%, 96% on 101 Ellwood. Brewers Hill is like 96, 94%. So there's a significant demand for apartments in Baltimore, particularly in this part of Baltimore. So this is a great thing for our business plan. Once again, some of this were built in 2013, 2014. This is 98% occupied already, 99% occupied. Just look at the average rents in these properties that are just close by. I mean, this was built in 2013. Ellwood was built in 2014. 2,000 to 3,000 here. Look at that. Here, this Tindico Wharf, 1725 to almost $3,000. This was built in 1985. Granted, this is right next to the water. The Gunther, which is close by, also built in the same year, occupied 96%, and the price ranges from 1640 for studios to 2,900, almost $3,000. So average for this 18, 16 for Highland House. So this are all comparables here. And just to break it down again, on this slides, 101 Ellwood is going to be highlighted, and you could kind of just see how it compares to the average rents from all the other properties. This is it's towards the bottom here. You see all the different units, the terrace, the plus, the den, the loft, all are towards the bottom of 1 bedrooms in the area. Same with 2 bedrooms, completely towards the bottom compared to all the comparisons. So we are sitting really pretty with this property, with literally still this is still renting towards the bottom of the market, and we are not even planning to bump up the rents much. We still want to just get it to like maybe the middle of the market, or keep it close to where it is. Financial analysis. So once again, we get going into this at a 5 cap, and we already went over this slide. We are assuming a loan on this particular property. The loan to value on the loan is 73%. We're going in at a fixed interest rate of 4.9%, and the term is 10 years, but we only have 3 years left on it, just when we are planning to exit this deal. And the use of the funds that we are raising, the $9 million that we're raising, is 6.25 of it is going to be down payment to essentially take over the loan. And closing costs is going to be a little over $500,000. The acquisition fees is a little over $760,000. The value add cost is a little over 1.1 million. You add all of this together, and it gives you a little over 9 million that we are projecting to raise on this deal. Of note, we've raised a little over half of that already. So we are looking forward to finishing up the raise pretty quickly. This is going to close really fast based on our experience raising for this deals, particularly a beautiful deal like this that we are getting at a very, very low basis. Just a little bit on the pro forma. The break-even occupancy is about 77.79% on, that means we will have to drop down. Remember, we are going in at 96% occupancy. We have a lot of room here. So we will have to drop down to the 70s, so 80%, to be concerned about being able to pay our mortgage on this particular property. That is a good thing. And just to see, we are hoping to get the total expenses down to the 40s, a little bit less than the 50% where that it currently sits at. So and we are hoping to also get the economic vacancy to be a lot less than what it currently is. So this is more of a management play. This is the perfect deal for this economic situation that we find ourselves in, where we are either in a recession or going into a recession. Y'all, you want a deal like this where you don't necessarily have to bump rents severely. We're only increasing rents by 3%, even though the CoStar is projecting that the rent increases in the market is going to be more than 5%. And we are already at the bottom of our comparables, meaning even after increasing the rent by 3%, we still not going to be even at where the comparable properties are. And when people can't afford those other properties, guess what the kind of properties they come to? The ones where we're going into, where there's still so much room to go, where the rent is completely reasonable and completely closer to the bottom of the market. So just a little bit more on the pro forma. 6% cash and cash is what you can expect to. There's no real preferred return deficiency. We should be having a significant amount for cash flow distribution, even after paying our principal and interest on the property in years 1, 2s, and 3s. This is the management team. We've been able to acquire $142 million worth of assets in the last 2.5 years, and I am proud to be the leader of this incredible team made up of Mr. Tenny Tolofari, our co-founder and director of acquisitions, and Mr. Leslie Awesome, our co-founder and director of operations. I am fortunate to be the leader of this team, but also we have an incredible team with Macy Price, our marketing specialist, Manny Awesome, our underwriting specialist, and Miles Hills, our acquisition associate. We also have some strategic partners that have been on a lot of our acquisitions with us, both Chris Lento and Brad Kangemila, both very experienced developers and multifamily sponsors who have multifamily units in multiple places throughout the country. They have been great partners to us and continue to be, and they are super excited about the prospects of going on this additional acquisition with us. We are bringing WPM property manager or real estate management, who are very experienced local management teams and local property manager to manage this particular property. They understand exactly what the market is doing, and they are very excited to be joining us, to be helping us to stabilize this particular property, to reduce the expenses and get the rent growth or the minimal rent growth that we are projecting. Our portfolio includes the Griffin, Land Bank Lofts, Mountain Vista, which we just closed on last Friday or 2 Fridays ago, Elevate on Main, and the View at St. Andrews in Columbia, South Carolina. Later on in this talk, I'll show you what we're doing with the View. But yeah, that's exactly it. The View is just one that we acquired in last April, and we are in the process of disposing that off. The close date on that is in mid-December, and we are going to be selling that at a 41.8% increase in valuation. We expect to be able to do the same with this. We had projected that we were going to hold that property for 5 years, but we got an opportunity to sell it at a little over $5.2 million more than we bought it. And we felt like that was going to be a good thing for our community of investors. And yeah, we promised them 18.5% on that and achieved an average annual return of 34% on that one. So under promised, over delivered. That's the same exact thing we hope to do on 101 Ellwood. Thank you so much for taking your time to listen. I hope you have a lot of questions because that's what we love. Please drop those questions in the Q&A or in the chat, and we'll be more than happy to answer them in significant details. Just a little bit about the timeline. Today is the webinar. Obviously, we would like to have all funds in by December 2nd. We are hoping to close on this. The tentative close date is December 15th. So yeah, if you have any questions about that, please let us know. If you feel like you've seen enough and you feel like, yes, I am ready to go, and please feel free to scan the screen and just go ahead and soft reserve. I mean, make a commitment, and we'll take you through the process of making sure that you can send your funds in as quickly as possible. But yeah, this is a super exciting one. We have a lot of, we've just made this public right now, and we've already gotten so much interest on it. And even before we made it public, we were already able to raise close to 58% of what we need on this particular property. So if you're listening right now and you think that this is a good fit for your portfolio, go ahead, make this soft reserve, and let's get you through the process. This is going to fill up pretty quickly, and I do hope to have you join us on the ownership group of this particular property. Thank you once again, and I'll stop there.
Thank you so much, Chairman. This is an amazing presentation. We already have a lot of questions coming in, and I'm gonna try to read them to you, and then you can go ahead and answer. So we have one from anonymous attendee. It says, "Hi. How do these rent projections compare with the changing market conditions as we go into recessionary period? Also, any reasons why the current rent is below market rent or market rate? Thanks."
Those are great questions. So thank you for that question. The rent projections are exactly in line because of the market conditions, because we know we're going into a recessionary period. So we are saying, you know what, we are not going to project a 5% rent growth like CoStar is projecting. So we are just going to do 3%, which is classic, which is normal. You know, that's what typically happens. Rent usually doesn't go down. It usually stays flat or goes up a lot slower during recessionary climates. So we fully expect that we are going to be able to meet those rent projections. Why is it that this property's current rent are below market rates? Because it was poorly managed. Because guess what? Just like I told you earlier, there was no property manager that actually lived in this. There was no in-house property manager for anything more than 6 months on this particular property. So that is a recipe for disaster when you don't really have somebody right there constantly making sure that the residents are, like, you know, being well, the concerns are being well addressed, that there's prompt responses to all the maintenance needs that they have, that there's somebody there consistently checking the market to make sure that we are, you know, at least competitive with the market. And there are also a lot of concessions just to because they were trying to just, fill out this particular property. They give a lot of concessions, give a lot of free months and free parking and all those types of things that made the effective rents relatively below what the market is doing. Also, there are a lot of other hub sites on this particular property. Things like the parking. There's a lot of revenue growth that we could get from the parking, because right now the parking is at least $100 less than what the comparables are in this downtown Baltimore property where there's no parking and there's indoor parking for our renters. We could definitely do well, and that's not something that we've actually fully accounted for in our underwriting, because instead of accounting for a bump in the rental numbers in the prices for the parking, we've only accounted for about 60% of that in our underwriting. So that's one of the ways that we underwrite this conservatively, and that's because of the changing market conditions. This is that perfect property, a property that we're going in with a very low interest rate, that has been locked in, 4-point-something% interest rate. I mean, you can't find that anywhere right now. So those explanations that I just gave are the reason why we feel very confident about this particular business plan.
Thank you so much, Dr. Julius Oni. We have Winston Shaw asking if it's a 506B or a 506C.
It's a 506C offering, which means you have to be an accredited investor to invest in this, which just means that you need to make at least $200,000 as an individual or $300,000 as joint income with your spouse. Or if you just have a net worth of over $1 million, that's another way to qualify as an accredited investor.
All right, thank you. And then we'll have a question from Omosalawa
Adewale. You gotta pronounce
Adewale. Did you say this was converted from school in 2014?
Yep. This was a whole old school building that was converted into apartments, beautiful apartments, if I may say, in 2014. Yes.
And to add to that, we bought a property in Columbia, South Carolina. Our last two deals, that was a bank that was converted to apartments. So that was a good track record that we have, and we assumed the loan from Fannie Mae. And that's why the seller saw that we're really qualified to buy a deal like this. And that deal in Columbia, South Carolina is doing outstanding well. So we have a track record and experience for buying conversion deals.
Absolutely. So land bank loft, just to let people know, if you go to our portfolio, you can just click on land bank lofts. That's the property that Tenny is referring to. And that's another conversion deal where the bank was converted, and we are doing fantastic on that one too. Currently, we expect to do the same on this particular property.
Thank you. And yes, Kelechi, we'll make sure you have the recording. Miles, please make sure everybody on this call gets the recording of this.
Everybody who is present here or who registered for this will be able to get a copy of the recording for sure. So no worries. And I think Jason was asking, do we have any background on why this property is on the lower hand rent and occupancy rate? Jason, I think I answered that question earlier, but if you need me to answer additionally, I would love to. And Jason, thank you for your previous investments. We really appreciate you. This property, once again, just to summarize, lower hand rents because it was poorly, I don't want to say poorly managed, but it wasn't managed optimally. And the occupancy rate is still relatively high. I mean, 96% is pretty good, but they gave a lot of concessions away. And that's why the effective rent is relatively low.
We have a
anonymous.
question from anonymous attendee about 401k.
Yeah, so yeah, 401k contributions definitely qualify if it is self-directed. So self-directed retirement accounts can still be used to invest in this particular deal. You just don't have to use your cash only. The only caveat is that after every one of these deals, once we buy it and we figure out who is going to be on the ownership group, whoever is usually first come, first serve, whoever puts their money in first, it comes in, and once we've raised the entire amount that we need, then we can't take anybody else's cash. So for everybody that invests, we do something called a cost segregation study that determines how much depreciation everyone can get on it. So typically for this, it could be anything from like 30 to 40% of your amount invested. For example, if you invested $100,000, you may have almost $40,000, maybe $35,000, maybe $30,000, but we'll do that cost segregation study, and you could offset all your passive income with that depreciation. And if you have achieved real estate professional status, or your spouse has achieved real estate professional status, then you could actually use that depreciation to offset even your earned income, your W-2 income, your 1099 income. So this is fantastic. And this year is going to be the last time you can actually do 100% bonus depreciation and accelerate it in the first year. Next year it goes down to 80% and starts to step down from there. But this is this is a great tax benefit for investing in this types of properties in this type of model. So cost segregation studies, fantastic tax benefit of investing in this. And Jason wanted to know a little bit about our strategic partnership. Yeah, Chris and Brad are like are great partners to us in the sense that they come in as key principals. So to purchase any property like this, you need to have a net worth of that is equivalent to the price of the property. And you also need to have liquidity that's at least 10 to 15% of the total acquisition cost, of the total price that you're buying the property for. So Jason, what Chris and Brad does for us is, one, they bring some of their asset management experience to assist us and to work with us to manage these properties. And many of the properties in our portfolio, we've partnered with them on. And also they, in addition to us, pool our net worth together to be able to meet the net worth and liquidity requirements for acquiring these types of properties. I hope that answers your question. Any other question for me?
Yes. And then we have another one from an anonymous attendee again. It says, how does a return of 6% annually compare with the inflation rate?
With the inflation rate?
Yes.
If that is asking about the inflation rate that is going to be, there's no way for me to predict what inflation is going to be next year or the year after, but certainly, I guess a good way to say it is, if you left that money in a bank account, that money will, the purchasing power on that money, if inflation was 6%, let's say for next year, then that money is going, the purchasing power of that money that you left in the bank account is going to be that much less, 6% less. If you left it in this deal and you got it 6% cash and cash, now the quality, the money is at least still growing, and it's growing in a deal where you have the potential of the upside of making a 1.5x equity multiple on your investment. Meaning, if you invested $100,000 in 3 years, you can end up with $150,000. This is with the most conservative projections. And this is why this particular property has been a hit. I mean, before we even made it public, we were able to raise over almost $5 million on it.
Thank you, Chairman. Ali Samara is asking, congrats again on another great deal. This property looks fantastic. Can you provide more insight on the debt structure you're looking at here and whether a mini perm is built in?
That is a great question. Thanks, Ali. The debt structure is just straight up an assumption. We are assuming the existing loan on the property, and and this is something, just like Tanny said, that we already have significant experience with. With regards to the mini perm, I'm gonna have to defer to Leslie, who does a lot of our underwriting, to try to respond to that. Les?
Hey, thanks, Dr. Oni. Ali, great to see you again. Ali is a great mind on the in the multifamily space, so always great having him on. Ali, we don't have any mini perm factored into the debt structure, just the straight assumption, like Dr. Oni said. And that assumption runs out in year 3, which is why we're going to be exiting in year 3. So it's fixed 4.09% debt, no more IO left. So we'll be paying principal while we own the deal as well. So we're building equity too in that area by paying down the principal as well.
Awesome. And what's the minimum investment? $50,000 is the minimum. And Winston also asked, is there going to be a cost segregation? Yes, sir. Yes, sir. There will be a cost segregation, and you will be getting details on that soon. Explain the passive income a little more with regards to offset. Oh, great. Well, what I was trying to say when I explained that is that with the depreciation that you get on this, so for example, if you invested $100,000, right, in this particular deal, and we find through the cost segregation that the depreciation is going to be $37,000. Well, you can take all of that $37,000 in year 1 if you wanted to. The $37,000 you can use that to offset the passive income coming from the property. So it's $6,000. You don't have to pay taxes on that. So $6,000 already offset. And then about the remaining $31,000, you can use it to offset any other passive income that you have. However, if you or your spouse have achieved real estate professional status, now you could also use that $31,000 to offset even your earned income, your W-2 income, your 1099 income, and so on and so forth. However, if you investing through a retirement account, obviously the retirement account is the investing entity, and so you personally will not be able to take advantage of this tax benefit. Yeah. Tanny?
Yes, sir. That's that's one of the. Then are there any IO left on the loan? The answer is no. Leslie answered that.
Which is a beautiful thing, Winston, because guess what? We are going to be paying down the principal, right? Which means we are building equity already just by doing that. So this is going to be that's actually a good thing. Yeah.
And then Patrick Aura asked if we cannot exit in year 3.
That is a great question, Patrick. Yes, we will have to get a new loan. But we've studied like the macroeconomics of the market currently, and even the most bearish projections assumes, are saying that, you know what, maybe the interest rates keeps going up until 2024. That's, but by then the interest rates should start to come down significantly. The question is, where are we coming down from? But even with those projections, everybody is projecting that the interest rates are gonna peak at some point next year, potentially. Maybe they extend all the way to 2024, but certainly they're gonna start coming down. The hope is that by the end of 2026, 2025, almost 2026, that we should be in the favorable environment where if we cannot exit, we could just obtain a new loan. And remember, we would have been paying down the principal, so we'll have quite a bit of equity in the deal, and hopefully the revenues are much higher. And so this would be a very attractive deal to get a loan on at that point. That's the hope. Any reserves?
Yeah, no, Chairman, before you leave that subject, can you share more about the evaluation of the property right now? The valuation.
Oh, yeah. So I mean, you know what, Tenny? Let you do that, because you know you do a lot of work with the acquisitions part. So go ahead and talk about how this is actually valued in the 30s, and we're buying this in.
Leslie's itching to talk. Go ahead, Leslie.
Okay,
you know that's a good news. So I want to be the one to share it. Thanks for letting me do it. But anyway, so like Dr. Oni mentioned, we're buying this property at a really low basis. Just to give you guys some insights, the current owner of this property bought this property in 2019 for $26.5 million at $189,000 per door, and we're buying it way lower. And part of the reasons is because of certain relationships that we've created in the market that got us exposure to this property, and some of the insights on what the opportunities are with the property. As of today, based on average effective rent in the market, RealPage is valuing this property at $33 million. That is averaging out the effective rents in that market and looking at how the other properties, the other comps are performing. RealPage believes that this property should be valued at $33 million. Obviously, our valuations have been a little high over the last 12 months, but that just gives you an idea of like how solid of an investment this is. So we're certainly very, very excited about this opportunity. And thanks, Tenny.
No, I see you came off mute. I'm like, all right, let me let you do the honors.
That is awesome, guys. Yeah, so yeah, we are going into this at a very good basis. Really excited about it. Any reserves plan on maintaining during the life of the project? Yes, sir. I actually showed you the reserves that we were planning to maintain on the screen earlier. I could pull it up again if you need me to. But yes, we do plan to have some reserves on this particular deal. So I'm going to try to pull that up.
And then one last question from Winston.
Operating reserves right there.
Okay. And then we have a question about 1031, if somebody can bring 1031 to the deal.
Oh, yeah, absolutely. We already have a lot of 1031 exchange coming into this deal. That's actually, I would say, a good number of our money already committed to this deal are going to be 1031 exchanges, not just from outside, also coming from our deal that we're disposing off in a few weeks.
And then another question is this the only deal you have right now from anonymous attendee?
Anonymous attendee, let's chat. I may have something else for you, but yes, this is the main deal that we have right now. We just closed on another deal, but I may have a spot for you on that deal if you think that deal is a better fit for your portfolio. But yeah, this is the only deal that we have publicly available. Yeah, but if you do have some interest, we can chat.
And the last question for anonymous attendee is, what is the process for investing with 401k? I believe my 401k is self-directed.
Beautiful, beautiful. Just chat with either Leslie or I, and we'll put you right in touch with the custodian that can help to make sure that that process is smoothly facilitated for you.
And that is all the questions we have, Chairman. Thank you so much.
Beautiful, beautiful. Any other questions from the audience? Please feel free to jump in. But this is an incredibly beautiful deal, and my hope is that within the next 2 weeks, that before that December, even before the December 2nd all funds end date, that we'll be wrapped up with this deal. My goal is by November 28th that there should be no space left on this deal. I think we en route to doing it. I have complete faith based on the basis that we get in this deal, and the fact that this is going to be a great way to grow your wealth, particularly with this unique market conditions. I think we have a great one here, and we can't wait to welcome you on the ownership group of this particular property. Thank you so much for taking the time out to come out and listen to this webinar. We look forward to you joining the ownership group. And if you have any questions, please reach out to us.
Julius, before you leave, there was a question about boilers. No, the property does not have any boilers.
No boilers, Winston. No boilers at all. Tenny, Leslie, did I forget anything? Please feel free to add any comments.
You did an amazing job. We're excited about this asset. So jump in, let us know, and first come, first serve, like Dr. Oni said.
Fantastic. Excellent. Thank you, everyone. We really appreciate you joining us. Have a beautiful one.